I'm Troy Eckard. I'm the CEO of Eckard Enterprises. With me is David Moore, co-founder and CEO of Equity Advantage. We've had an additional presentation a few months ago. David will be with us down at our partners conference in Amelia Island. Super excited to have him at our conference. Have found his information, his wealth of knowledge in the self-directed IRA and the 1031 tax exchange market, real estate as a sector, just to be very, very impressive. And so I'm really honored. David, thanks for joining us today. I really appreciate you taking the time.
Thanks for having me today, Troy. Looking forward to it. I always enjoy talking with you.
Well, usually we're talking about guns and hogs. Today we're going to talk about making money. So we're going to try to stay focused. David and I both decided that slides are boring. We think that we're much more interesting than slides. So we're going to talk about the tax advantages of 1031s. We're going to try to give it to you in bite-sized samplings. But the thing I want each one of you to know is at the bottom is a chat. You have the chance to ask questions in chat. Use it, because while we're talking, either one of us can see that and we can kind of respond as to what's down in the bottom. But let me tell you how this works. We're going to go through and do some Q&A. We're answering y'all's question. We think we've sufficed with our time. We'll say thank you very much and let you go. We want to make the best use of your time. So, David, why don't you tell everybody a little bit about you, your company, and how you got where you're at today, just to give us an idea of your background, because I think it's quite impressive.
So I was talking to somebody the other day about how you get started and stuff. And I think a lot of times it's just because you don't know any better, right? You sort of look at something and you say, gee, why is it that way? And somebody will give you, I think so often we're sort of locked into what we perceive to be yes or no, or yes, you can, no, you can't, and so on and so forth. But I was blessed, as we were talking before we signed on today. My father was a doctor. One of his patients actually happened to have, in the late 70s, early 80s, one of the largest exchange companies in the business. And he knew a good name, so he named it Starker Services, which none of us use the term Starker Exchange anymore, because he took that name and created a business with it, and he sold that company. But Starker's still around, but what happened is during the World Series earthquake, his house went down a mountainside, and he said, I don't need to do this stuff anymore. And he just really took off, and he'd had a lot of real estate investments during that period of time. He was a retired broker. The stress of that was too much. Thought he had a heart attack, so he put the exchange company together. But my brother Tom and I, we'd get in his minivan, ride from Santa Cruz to Oregon, back and forth, these 12-hour information downloads. And, getting into these things is always a case of having a good mentor a lot of times, right? Somebody you're going to learn, because you're going to learn in life, whether you get kicked in the head or not. And I always like to say, hey, I'm always happy to learn. I'm tired of being taught. So if you can learn from somebody else's mistakes, it's definitely a big advantage. Well, Ron got us into investing, and he kept my brother and I from making mistakes in that space. But as the investments worked out, we needed exchange work done. And there wasn't anybody in this region really at that time in 1990 that did exchange work. So we put Equity Advantage together at that point. It was really a result of demand. And also we just sort of looked at it as more contacts for more assets going forward, because that's what we're looking for, things to buy. And, during the ensuing years, about 15 years later, we ended up putting IRA Advantage together. And that was once again a situation where, don't tell me what I can't do, tell me what I can. And just hearing all this information out there that wasn't really accurate, and saying, well, hey, why not? And so we don't sell investments. You made the comment at the top. We don't sell investments or give investment advice. We're just the person that provides the investment vehicle. If we're talking about tax money, it's going to be via 1031 and Equity Advantage, 1031exchange.com. If we're talking IRAs and 401ks, you're looking at IRAadvantage.com. And either way, we're going to sort of look at what you have and where you want to go with it and figure out how to get you there. So really, if you look at a 1031, it's just a conduit out of what you don't want into what you do want. If you're looking at self-directed retirement accounts, IRAs or 401ks, any restrictions that somebody has today, as you know, is simply because the custodian or the plan document in those situations. But really, there's so much out there that people can do that they really have no idea. And we sort of jokingly said earlier too, anytime you know something about what you're reading about in today's world, especially with social media today, you know how wrong it is. So if we look at 1031s, we're talking a tax code that celebrated 100 years this year. If we're talking about retirement accounts, we're talking about rules that came into play in the mid 70s, and they really haven't changed. If we're talking about what you sell today, I mean, what's the roots of that go back into what, the late 50s and the 60s, right? With the like kind definition change and what's going to make it possible.
Right.
But, really, I like the old KISS principle, keep it simple, stupid. So if I'm looking at a retirement account, I'm looking at two factors. What does the person want to buy? Who are they transacting between or for the benefit of? Those are the two primary issues in that space. If I'm looking at 1031s, I'm looking at four issues. One, it's got to be an exchange. Somebody's got to give something away, be giving something back. The items relinquished and received have to be of like kind. You need to go across or up in value and equity for total tax deferral. And one of the big fallacies in the 1031 space, and you'll appreciate this in what you sell, is that people are always told they have to replace debt in an exchange. And that's totally untrue. Debt can go away two ways, one by adding cash, the other by going down in value. You go down in value, you have tax exposure, you add cash, it's fine. So in times where we've got recessionary times, for example, what happens to loan to values? Those things typically decrease, and a lot of times your equity is decreasing. So you're needing to add money to a transaction. I've had people say, well, do I need to pay the property off pre-disposition if I'm buying something with no debt on acquisition? And as I said, that's totally unnecessary, but that's just one of those fallacies that's out there. And then finally, the fourth cornerstone is continuity of vesting. That just means the taxpayer that relinquishes has to receive. Now, even though the code's 100 years old, I took a call yesterday from somebody that closed the deal the day before and now is wanting to do an exchange. So, there's so much information that's out there, but there's so much information that's not out there. And, we talked a little bit about flying earlier, but, I've got a buddy that's talking about diving yesterday, and scuba diving. The whole deal is you plan the dive the plan. You've got to know where you're going. So people, when they ask me about an exchange, when do you want me to think about the 1031? I'm going to tell them a lot of times when they buy the asset, if I've got the ability, but at least when they consider selling it, they need to think about it that time. Don't think about it after it's closed. You've got actual constructive receipt, you're going to have a problem. But you figure things out in advance.
So let's slow it down, because I got 3 or 4 things you hit on that really, it doesn't make sense, and you would think it wouldn't occur, but it does. So here's number one.
Sure.
One, why would an investor not know about 1031 in today's information world?
Well, I think that you've got to look at who you're working with, right? And if you're working with brokers that, number one, do you have to have a real estate broker to sell a piece of property? And obviously the answer is no, but if you're not going to do it, you're not going to be able to benefit from their knowledge. But if you're looking at investment stuff, you should be working with people that understand these things, understand what's possible, have some history of it. And, as well as I do, even the tax and legal community, a lot of this stuff is just not known out there. So it's really.
How does an investor, how does a guy, a gal, a person go buy real estate, know you have something to sell, and not get online and actually take your time and figure out what those advantages are?
I think it's maybe too much time on social media. I don't know. I mean, that's the deal. If you look at it, I think you got to focus on, right, you're buying things with the anticipation that you're going to make money on it. Wouldn't you be concerned about keeping that money yours? So we like to say you've worked hard for your money. We work hard to keep it yours. But it is really amazing at how often people will make money and then they just end up giving all of this back. And it's unnecessary. I mean, I think a situation that you really have to look at is, 1031 applies to property that's been held for investment and is acquired with the intent to hold for investment. There's, one of the big fallacies is timelines. How long do you have to hold something to have it considered held for investment? And a lot of times people say, well, the code says 2 years. It doesn't. If Troy Eckard and David Moore are brothers and we swap properties, now we've got a 2-year hold on a related party transaction. But if you read the fine print, even a related party transaction, it's not an absolute. It says unless there was no intent to avoid tax. So I think there's just, people don't ask the questions. And then a lot of times the quote unquote experts are not getting the information out. And if we're looking at a real estate purchase sale agreement, Troy, I think we're in a world of nobody wants to take accountability for their actions. So if you look at a purchase sale agreement in most states, the state forms for the association of realtors, let's say, maybe if we go back to the 90s, there was a box that you'd check stating, or you'd have to write something in that purchase sale agreement stating it's my intent to do an exchange. Excuse me. But in today's world, they've taken, you don't write it, and it went from that to maybe checking a box that you're going to do it or your intent is to do it, to a point where now you've just got a boilerplate disclosure, and it's just there really to sort of cover the realtor's tail in that, well, gee, you didn't tell me about an exchange. You can still do it until it's closed, right? So people aren't really thinking about this stuff and planning it out and asking, basic questions. You've made this, do you want to pay the tax?
So the second part is, why is there so much misinformation? Because isn't the qualified intermediaries, aren't they regulated? Don't they have some kind of organization that says, all of you, kind of like a FINRA brokerage firm, right? You all got to have rules and regulations. How can there be that much disinformation or bad or incorrect information from 1031 QI to QI to QI? Because we're in the receiving end as a product provider that is qualified for a 1031 exchange into minerals. We're hearing all these 1031 exchanges where there's problems with the QI, can't get the money released, paperwork's not done. How do you do that for a living? And not only do you provide bad information, but it just is dysfunctional in execution. So I know you're in the business, you do it. I know you have an incredible reputation with your business, but just give me a short summary why you think that information is out there. What's causing that problem?
Well, I think it's just standardized knowledge. And the only trade organization we've got is the Federation of Exchange Accommodators, right? So you've got 1031.org. And that organization, I was on the board of directors for it in the mid-90s. And during that time, they had initially proposed something that ended up what's called the CES, Certified Exchange Specialist. And I was, when I was on the board, that idea was proposed, and they said, okay, hey, we want to standardize knowledge, and we're going to put this test together, and it's going to have, let's say 100 questions that have right or wrong answers. Well, in tax law, how often is there a black and white right or wrong answer on stuff? Rarely is the question whether you can or can't do something. It's how you're going to get it done. And so I was sort of, at that point, I was sort of against it, because you could not convince me there were 100 questions with right or wrong answers. And I would still stand by that. When I took the test, I don't remember how long ago it was, but when I took the test, I walked out. One of the guys that was on the board with me during the mid-90s said, well, what do you think? And I said, well, yeah, it was pretty good, but there's a few questions in here that are just wrong. And he said, oh, really? And he said, which ones? And I told him. And the idea is that we don't have a situation where you've got federal tax code that gives you guidelines on things. You've got some states that actually put out practice manuals for the bar associations. For example, California, they put out revisions every single year, and they've got a nice big book, and it contains practice suggestions and case law. But most states don't have that. And so you're looking at this thing that's out there with one organization to standardize knowledge and to be bonded. Anybody that treats 1031s as a profession should be part of the should be part of the CES program, should be part of the Federation Exchange Accommodators. And back to your comment on regulation, it's not something that you're licensed state by state. Each state might have different requirements for what is involved or what allows you to do exchanges in that state. But really, we're looking at, and people say, well, gee, you should have more rules. You should have licensing. I said, well, why do rules and why do licensing occur? They occur out of fallout of problems. So the fact that there isn't more guidance in this space is really testament to the quality of the firms involved. Now, I wouldn't do an exchange with a company that was a one-person show, because, what happens if that person gets in a car accident? You've got your money locked up and you can't go buy something. So you owe it to yourself to work with a company that's, a professional company that's got a staff of people there, so you don't have everything locked up. But as far as national, licensing, it's not there. To be part of the FEA's bonding programs, you have to be in there. You have to be in good standing. And we've got a code of ethics. I chaired the ethics committee in the mid-90s, and we've got things that are there. We do our best to put teeth in that stuff. But really, it's a situation where you got to look at the companies you're working with.
So the third aspect would be, I've done several presentations. I have a couple of partners who actually specialize in 1031. They're either helping people facilitate that, or they're actually part of a QI, and they've invested with us in minerals. So the question I would ask you is, all right, so I'm a real estate investor. I've been investing the last 10 years, been buying rental houses, I've been buying investment property. Now I want to go find the right QI and the right source for getting my properties sold, have a successful 1031 exchange. What's the best way for me to find the right match for the right qualified intermediary that gives me accurate information? I have reliance they're going to be able to do the back office to accommodate the closing deadlines. What I heard last year was so many QIs were so swamped, they were literally turning people away saying, we will never get the paperwork done in time. I'm sorry you waited too late, which either tells me one of two things. There's not enough QIs for the transaction quantity, or you just simply had top tiered QIs that everybody ran to. They were booked and you had started going down to second tier QIs. Take a couple of minutes just to address the amount of QIs that are available versus the transactions, and how would I, as a person looking to do a 1031, could find the right fit? How does that look?
Well, I think the best thing to do is just start off the FEA's website. I mean, if they're serious, if they're professional, if they've been doing this for years, they're going to be part of the FEA. Now, something that people get confused about is they think, well, gee, if I'm closing a deal in Texas, I need to use a Texas QI or something like that. I would say that's totally irrelevant. I would say work with the companies that are going to get you taken care of, to your point. I would take a look at the FEA site, and then I would take a look at giving each of those companies, prospective companies, a call. Because the thing is, a lot of times, and you're going to appreciate this, people's first question, well, what's it cost? Well, that's nothing. I mean, the cost of a QI in a transaction is typically going to be the smallest item on the settlement statement. I mean, you're talking, $1,000 to $2,000 for a basic exchange, regardless of size. If we're talking reverse exchanges or improvement exchanges, maybe you're talking $5 to $10 grand to get those things set up, but you're looking at a nominal amount. So the QIs that are doing business, to your point, I mean, it's a volume transaction situation these days. And you've got to make sure you're working with people that are going to answer questions. Don't just ask the cost. Talk to them about what's going on. Talk to them about your exchange. Ask them questions specifically with where you are, where you want to go on this stuff, and see what their responses are. And it's sort of interesting because if we go back, pre-91, for example, everybody that was in the exchange world was very knowledgeable, and they had a lot of background with investments, and you could ask them a variety of things. And it went from that to, after fall of 91, when the codes were sort of formalized, you had a situation where a lot of companies were just put together as a side corp for another company, and now it's a paper shuffle. So if you ask them questions about a specific issue, you're not going to get an answer. And it's really important, especially, over the last, couple of years with COVID, that you understand when you can get access to money and things. If you've got a transaction that's, I hate the word failed transaction, but if a lot of times people just put a deal together, they don't know where they're going to go, and it's maybe by 45 days to figure it out, right? But you've got there's something called 1031 G6 that dictates when we can release funds through a transaction. And there's a term, accommodating accommodators. Well, an accommodating accommodator is not a good thing. So if you're working with, gee, I want to work with ABC accommodator because they'll just give me my money whenever I want it. Well, that fact alone torpedoes every transaction that exchange company does. It's not whether you or they want to jeopardize your transaction. The policies or procedures of that company are bad. So you really got to understand what's there and have transparency and educate people. I mean, if the reason that I reached out to you, or my team reached out to you, 6 months ago to put a video together, is that, I don't sell what you sell, but I want my people to have access and knowledge of what's there. So we try to really provide information to our people of what's possible. And sometimes the exchange is not the right thing, to your point. I mean, if you want to buy 45 days to figure something out, that's great. But what good is tax deferral if you're paying through the nose for stuff, right? And so in today's market, maybe you're better off paying a little tax, sitting on the money, having patient money, and jumping on things when you have the opportunity, instead of burying all your money, paying a premium, and having a problem.
Well, yeah, and I want to touch on that a little bit later, because you and I talked about it before we started about, at what point in time is paying the tax better than overpaying for assets that are heated, overpriced, or don't make economic sense. So got a couple of questions. One of our viewers, I was just asking, in the world of 1031 exchange QIs, how much data support information do you guys have as far as like accounting information or legal information, or you guys don't really touch on that? You say, look, you got to get your own lawyer, you got to get your own IRS opinion from your CPA, or do you guys give them pretty much generic answers subject to you reviewing it with your own professional? How does that work inside your world as far as tax and legal?
Well, so, I wanted to study up just a little bit on what we talked about last time. So, I watched the video, and I watched a couple other videos that you did last night on YouTube, just going over some stuff. And
sleep right off the bat, didn't you? You said it to me, you were crashed out.
Yeah. So then I looked at some other stuff, and I wanted to sort of see both sides. But, the idea is that a QI is not supposed to give tax or legal advice, right? And we can't. We've got to be careful, because we can't have an agency relationship with a taxpayer. We're acting as an agent of the taxpayer, then we're not going to be able to act as the QI. Yeah. So that's why your lawyer can't do your exchanges, right? So it's obviously very important that we maintain that independence. But the problem is that we're the ones with the knowledge. So when we have something, and I'm really vehemently against, having people paying their tax and legal people to learn on their behalf, right? I want them to go to tax and legal people who are going to provide an answer, not provide a bill to find the answer. Right. So if we're looking at something that's a gray area or anything that we're concerned about in a transaction, typically we're going to put the information together, get it out to our taxpayer, have them get it in front of their tax counsel, and then they can make those decisions. But I want to cut the fat out of the deal and make sure that I'm giving them information that's on point, and then they can have that good conversation with their tax and legal people. A common question might be, well, gee, how long do I have to own an asset, right, to qualify for 1031? If you type that in online, you're going to have 2 years come up all over the place. You might see 5 years come up someplace. Well, like I said earlier, 2 years applies in a related party transaction, but it's not an absolute. If somebody wants to push me on that issue or topic, I'm going to say a year based upon a couple of factors. One, it's been proposed a couple of times. Two, the break between short, long-term tax rates on assets held for investment. With that said, I can give you a court case where 4 months was long enough. So, and I can also give you a court case where 5 years wasn't long enough, right? So it's really one of those things where somebody has that question. I'm going to get the information together, get it to them. They're going to talk to their tax people about it, figure out what is good for them in that scenario. But, that's just one example of a big question that has no real hard answer there. And then the 5 year hold situation might come up if somebody bought a property and they convert it to a residence, and then they want to sell it using section 121. They think, well, hey, I buy it, 121 says I have to live in it for 2 years, and then it's good. So I buy the property, hold it 3 years, I sell it, take the exclusion, I'm fine. No, you're not. If you sell it within 5 of buying it, it's fully taxable sale. After the 5 years, is subject to something called the Housing Assistance Tax Act of 2008. So anyway.
So if I summarize what you said, essentially at your organization, which may apply to other 1031, you're going to help that taxpayer, that potential client of your exchange, at least source information that can lead them to the ability to narrow down what they might provide a CPA or lawyer, because that's part of why you have an exchange and you do it every day. So answering most of the questions, it's probably rare you run across a question you haven't heard or seen or at least been familiar with. So you're not going to give them that legal advice or CPA advice, but you're going to say, look, based on what we know, here's the data, do with it what you want, make your own conclusion or give it to your own professional, but you got to come to your own conclusion, correct?
Correct. Well, and the other thing, Troy, is, and this, I mean, how often are you shocked that they don't have good tax and legal people or don't pay anybody for tax and legal advice? I mean,
90% of the time.
Yeah, I mean, and if they do, when are they talking to them? April 14th, right? So, I mean, the deal is that you should be talking to them pre-year end every year to make sure you're doing what you need to do. But get good. I think good tax people are one of the most critical people in your life, right? So so get great tax people and use them. Let them do their job. Don't just treat them as a tax preparer, right? So, but back to really in the exchange, they're going to get a spreadsheet at the end of the deal showing the cash flow of the funds, what came in, when it came in, when it went out, what they did. So they get a thorough accounting for that. They're going to want to provide that document along with the settlement statements from both sides of their tax people. And that's what is going to be required to do that 8824, which is a tax reporting. And really, it's a basis carry forward calculation for an exchange.
Let's talk specific exchange like kind items. So I'm in the oil and gas space. I know mineral rights qualify for exchange. Does working interest or buying producing wells, does that asset qualify? Because we know that in the traditional real estate, self-storage, residential, anything that's investment grade product or has been listed as an investment, traditional real estate qualifies. But let's start with the energy space. Would direct working interest or owning producing wells be the same as mineral rights when it comes to being a 1031 qualified asset?
Well, I mean, this is where you're the expert in this. But if we're talking about real estate, I mean, what's real estate? Real estate is just surface rights, correct? And what you're selling is basically subsurface rights.
Well, it's actually deeded and titled like the surface.
Yeah.
So it's essentially the same category. Working interest, though, and this is one I'm not really got an answer for. I don't know. That's why kind of one of my partners asked on the chat. Working interest is really a legal right to extract oil and gas from a well that's drilled.
Yeah.
I don't consider that real estate. It's a contractual right until that well stops producing or the lease expires. So I don't know if that would qualify as real estate in my view.
Yeah, and I honestly, I'd have to look into it further. I don't want to give a bad information out there. I mean, I know you guys have, you know, there's only so you asked earlier about information and why there's good or bad information out there. And I mean, as far as, you know, your industry is concerned, you've got, you know, to my knowledge, you've got a couple revenue rulings, you've got private letter rulings. And, you know, PLRs are not supposed to be used by anybody but that particular case, right? And you know, and so we're looking back to what Rev Rule 55, just wrote some notes, 55-526 talks about royalty interest in oil and gas in place constitutes real property for federal income tax purposes, right? So,
well, I think the thing is, even oil and gas accountants can't answer the question, which I've been doing this for 36 years. I'll be candid, everybody view it. I probably have fired 95% of my lawyers for being incompetent. I probably have fired 95% of my CPAs because they're either very, very sloppy, incompetent, or they're very limited in their scope. And when you have a diversified portfolio crossing major sectors, sometimes with a smaller CPA firm, you find yourself very constrained by their lack of exposure and experience, right? So I would challenge everybody here, whether you're doing traditional or oil and gas, or whatever else qualifies under 1031, you better find enough data to support the question, because you may not find that professional has taken the time to source it themselves, right?
Well, and to your point, I mean, when I said I looked up some of the stuff again last night as a refresher, I mean, on YouTube, which they say is really basically the largest search engine in the world these days, beyond Google on stuff. I mean, there's a handful of really pertinent information online there, and then you start looking it up. You know, Google this stuff, and there's a few law firms that have put some pretty nice articles together. But you know, and back to our statement earlier, there's lots of gray there. So, and there is information. There's a lack of general knowledge, and that's what brings us back down to working with people that understand that stuff. And you know, your comment on, or question on that stuff, we're to talk about IRAs or 401ks. You think 1031 is 100 years old. You've got a fair amount of case law in it. When you look at IRAs and 401ks, that space is only since the mid 70s, and we've got so little guidance there that is really full of disinformation. I'm convinced that in the self-directed world, a lot of the CE for the tax and legal communities provided by Wall Street firms, which they don't really have much interest in providing self-directed information or you know, things where we're talking about hard assets, tangible assets, and that's where people are going in recessionary times, right? So, I mean, I'm assuming that you're probably really experiencing an increase in demand, especially with just even the last few weeks with Wall Street doing what it's doing.
Yeah, I would say that there is a complete shift that I've never seen in my 36 years, where people are wanting more control of their money. They don't believe that the markets are fair because of the algorithm, the computers. Your hands are tied, you're blindfolded, you're playing just Russian roulette with things that I always say, if you can't see it, touch it, kick it, or feel it, you probably shouldn't invest in it. You know, the old Peter Lynch theory, if I can't draw it with a crayon, it's probably too complicated. I have another question for you that coming from one of the chats is that, you know, when you do a 1031 exchange, let's say that, you know, one of my partners has mineral rights. and they decide to sell those mineral rights, they want to exchange into regular real estate. How would they value that transaction? I don't think they value it. I think it's just basically whatever the sales price is. Their CPA might have to figure out what their basis is, the revenue received, no different than a rental property. But can you give any thoughts on that at all about how, you got production coming from your well, you decide to sell the minerals in 5 years. How does that look like as converting to maybe a traditional piece of real estate back into?
Yeah, so we look at those 4 points, and I'm just real quickly going back to your last question on, what those things are. When we're looking at like kind in 1031, it just refers to the nature of the investment rather than the form. So a lot of times people will say, well, I remember when it used to mean house for house, land for land. Well, 30 years ago, I had a little hair on my head. Today, I don't, right? So, I was the young guy then, and they'd say, well, I remember the house for house, land. It's never been that way, right? So it's always the nature rather than form. So people go through these things with these assumptions all the time that this is the way, they've done it this way and this is the way it is. And back to my comment on the napkin test and what you have to spend, that a crosser up in value and equity, and the whole fallacy that you got to have debt, to replace debt. And as I said, that's not correct. So when you're looking at when they're relinquishing what you've sold them and where they're going with it, we're just looking at the value of that thing going forward. And the value really is net of closing costs. But I want to stress, and this is very important in today's world, it's not all or nothing. So you don't have to fully satisfy the value and equity numbers in an exchange. Every dollar you're spending over the basis represents tax deferred gain. It's up to you to decide at what point you've bought enough. And what I tell people is every dollar you spend more than you want on something costs you $1. If you don't spend it, maybe it's, if you're in Texas, maybe it's 20 cents. If you're in Oregon, maybe it's 30. In California, maybe it's 35 or 40, right? So it depends where you are, what's going on, but don't spend more than you want. Every dollar spent over the basis on the property represents tax deferred gain. And back to my comment on working with professionals, that tax counsel, you want to talk to them before year's end, right? You want to know what's going on. Talk to them, understand what not only the liability is, the tax liability on its disposition, but what your liability in the year is, because you might be able to sell something somewhere else to offset those gains. And honestly, in today's world, if I can have patient money, and that means not 1031 money, 1031 money is very, very impatient money. I mean, you've got 45 days to find what you want, 180 days to bury that money. In today's world, to be buying, a great time to sell. Top of the market is a great time to buy. If you can sort of pull the money, set it on the side. You and I talked about, I think last time, you're piling up those pennies, getting ready to jump on stuff when the market pops, right? So what I'm going to tell people is you've really got to look at it and don't just buy something to defer gain if it's not going to help you out. If somebody's given up a property, these are 2 examples that happen all the time. Somebody might exchange out of a property they've held for investment. They want to go buy a property that they're ultimately going to move into at some point. Well, if they do that deal, it's great. They can do that. But what's the cost of you living elsewhere for the next year while you're waiting to season that property before you move into it? If it's California, you could blow, 80 grand on rent in that year. What's your tax liability? If it was less than 80, you went backwards. So, rationalize what's going on. And I think opportunity zones are one of those deals that I don't know how often you run across people considering those these days. But you're talking about a development play, right? And you told me earlier you just bought some land, you're going to build something. Well, how often does that project end up costing what you thought it was going to cost? And how often does it get finished in the timeline you expected it to? So you've got to really look at, and if we're talking development plays with an OZ, it's a 10-year deal. And what's your guarantee that it's going to get where you want to go? So yeah, you defer gain into it. I sort of look at OZs as a Roth IRA. You got limited deferral into it. What you make on it's tax-free over time. So you really got to say, okay, what's this true opportunity cost to have that money tied up for that period of time?
So let's go backwards just a little bit. So let's just use an example. All of our partners pay one-time upfront 100% equity into minerals. There's no debt. But a $500,000 investment, generate cash flow over the next 5 years, and they decide to sell it. The buyer says, I'm going to buy it for $750,000. I got a $500,000 asset. I make cash flow over 5 years. I sell it for $750,000. The cash flow has no relevance. it's the $750,000 sales price. I show a basis of 500,000 and I show a gain of 250,000. So now walk me through this. Do I need to move the entire 750,000 since there's no debt, or can I just move part of it, or what would happen in that scenario? And this will just help Cindy with a little bit of understanding, what that looks like on the backside.
Well, like you said, 1031's not all or nothing. And a lot of times people think, well, gee, I only have to exchange the gain, right? You've had that conversation. And that's not true. The government's going to get their sort of extract their pound of flesh before you get your equity without the tax. So, the answer to the question is, if you want to be totally deferred, you've got to go out and buy a replacement property or properties of 750 or more. But, I'm going to tell people, buy what you want. I mean, if you sold at 750, your basis at 5, and you want to spend 600, well, you're deferring the difference between the 5 and the 6. You've got exposure on the difference between the 6 and the 750. But, back to my comment, every dollar more you spend than you want costs you $1. If you don't spend it, it depends where you are, 20 to 40 cents maybe, or maybe it's 50 cents if it's a short-term gain.
So the follow-up question, and I'll answer this one, was, does the depletion affect the $500,000 base? And the answer is no, because it has nothing to do with depletion. I've got a mineral acre today that I buy for 500,000. I sell it for 750,000. The buyer's already factored in depleted reserves, depleted reservoir activity. They're basically, it's like a used car. I bought it for 500,000. I'm selling for 750. How many miles was it? Doesn't matter. The fair market value is what the guy paid for it. So you're still at the 750,000 range. It's more of a tax question with regard to, if you don't do a 1031 exchange, then you start looking at your bases, you start looking at your depreciation reserves. That's more of an accounting issue than a 1031 issue from the exchange capability. So,
well, and Troy, I mean, with your deals is a little different, but if somebody's selling just a piece of property, let's say,
right,
the question is, what has to be spent, and you're typically looking at what it is net of closing costs. Well, what are those closing costs? And how are they treated, and how they're treated is going to be, once again, up to the tax council that's involved, right? So a lot of times we might have something that would be a capital improvement, which would just impact the basis on something. But if it's part of a closing, maybe they expense it instead of capitalize it, right? So it really depends what's happening with these assets during the time they have it, and at time of disposition, how their tax people are going to treat these different costs. For example, on a real estate transaction, a lot of times you might have lender required repairs. Well, what's a lender required repair? I mean, that's an accommodation to the buyer, or technically to the lender? Well, that's not a normal cost, right? So how do you treat that? And how does that impact what you're going to do going forward? Most tax people will probably say, well, gee, and what happens if you're paying the buyer's closing costs? Well, most tax people are going to say, we're just going to reduce the sales price by X to do that. But once again, I think that so often people get really hung up. They want to get down to the penny on something. I said, look, buy what you want to buy. Be comfortable. Just to understand what the tax liability is going to be on that thing. And we're looking at the exact numbers. It's really something that you and I can't give the advice on, because it's truly discretionary between the taxpayer and their tax counsel, and how they're going to treat certain costs on those settlement statements, and what it ultimately means they have to spend.
Well, and the answer also in our world is that the depletion allowance really is an immediate tool, because let's say that $500,000 investment generated $100,000 in revenue this year. I'm only going to pay taxes on $85,000. So I'm getting a tax break immediately, because I don't pay taxes on the $100,000. I pay taxes on the $85,000. So it's not a double dip where you get to reduce your basis. You've already taken that as far as the income that you derive. Let's go through something else I think is real important. So this is just me. I'm a knucklehead. I do real estate. I listen. I always tell everybody I'm the dumbest guy in the room, so teach me. But I just want your own opinion. Has everybody, one or two things, have people gotten to the point where they're beginning to stop looking at the real asset because they're so busy trying to avoid the taxes? And are they making, really, like you said, buy what you want to buy? I just seem to find a lot of people scrambling to buy anything they can buy to avoid the taxes, when reality is, if you're overpaying 25, 35, 40%, it's higher than the capital gains you'd have paid. and you may be in an asset subject to what the economy looks like in the next 3 years, which may either be flat or negative. I don't think a lot of people today that I'm talking to, David, they don't remember 2008 and how fast equity disappeared and how fast you're out of covenants with your bank. They just don't remember that, or they're too young. Why don't you talk just a little bit about what you think the market's doing with regard to people that have been scrambling? Are they making good decisions going forward? And I know you're not judging them, but I'm asking your more professional opinion. What do you think's happening?
Well, I think there's a whole bunch of things going on, and you live in a state that people want to buy in, right? And I live in a state that people are, at least the people that live here, they're wanting out. And you know, I'll tell you, one, I see a fundamental shift in the ownership of commercial real estate, especially. I see the evaporation of local ownership by local people. The mom and pops can't afford to take care of stuff anymore, and it's because of all the government bureaucracy and stuff, and especially the last 2 years with the governors of states saying basically tenants don't have to pay rent, right? And I've got a client right now. He's a commercial broker developer that's been in the business. He's a Texan, you'd like him, for 40 plus years. And he told me the story yesterday of he had his tenants run out on him, just disappear through this COVID process. And after they moved out, some homeless people busted the door down and moved into the property. He can't get them out. You know, our wonderful, government here, the police have no power to get the people out. The government's not doing anything to help. And now he's got to have to hire people to get, hire lawyers to get these people out. And meanwhile, that insult to injury, he's having to pay the utility bills for these homeless people that have kicked his door down. So we've got a variety of things going on. I think, and back to what you sell and the DST space and where people are going. People are just tired of having to deal with the bureaucracy. So they're going into more passive investments, things like you sell, the DST space, Delaware Statutory Trust. I mean, they're having the major sponsors are having a hard time getting the assets because all the new companies come in. You made a comment earlier, and if you look at experience, and I tell people, especially going into DSTs these days, don't buy from somebody that hasn't been through a bad time. If they weren't in business pre-crash last time, don't buy from them, right? Because I lived through that mess as you did, and the thing is, if you haven't been through it, and you're working with somebody that's never seen a bad time, they don't know the bad deal. They think the banks are their friends. They think everything's going to keep going, and that's not the case. So I'm going to say,
doesn't that scare you though, David? It's terrifying me because I literally spent this weekend at a conference, and every single product provider was talking about, oh no, low interest rates. I'm going to flip in 3 years because the rates are lower. And I kept asking questions. I said, what is your stress test? And they're looking at me like, what are you talking about? I said, well, your question. Were you in business in 2008? No, it's amazing when you look at the antecedents of all these professionals. It's like they were all born in 2010 because nobody has a history before the date. I'm saying I would be asking what you did before because you probably were something that crashed. You don't want it on your resume. But more important is now you've recreated yourself. Now you're going through it and no one is ringing the fire alarm. This is coming to an end. It has to correct. That's what markets do.
So you think that last crash, Troy, and it's like, well, how did the government get us out of it? They dropped interest rates. Okay, since the last crash, what they do with our interest rates? They never brought them back up, so they have nowhere to go.
Yeah, we have no ace up our sleeve. We're done.
Yeah, so I really don't get it. So if I look at the DST space, and that's why I'm on this thing with you. You've been in the business. You've been through the good times, the bad times. And if you just put this thing together, I wouldn't be here with you because it's like, that last crash, I had so many clients that had problems. I don't want to have to go through that again. And if you look at DSTs, you have pre-crash, you had maybe 50 sponsors. Post-crash, you had a half dozen primaries that were left, a handful of heritage players. Today, we're back up to like 40 sponsors in that space. Well, and a lot of them are new. I mean, there was an IPO for one, I think in Montana, Wyoming. I got contacted by one of the government officials just asking about DSTs and, what they should know about it. And I said, well, look, I told them what I just told you. If they're coming in now, I'm anxious.
Well, here was a story back in the 90s. And then I've been doing this for 36 years. And back in the 90s and again in 2006 and 2007, and it holds as true as water. It says, When the real estate people start investing in oil and the oil guys start investing in real estate, you're at the end, because they've decided their own sector has no more juice or opportunity.
Yeah.
They're looking over the fence at the green grass. And I always have a saying, being an old redneck, I said, the reason why the grass is greener on the other side of the fence, because the cows have shit there and fertilize it. There's nothing good on that side of the fence. So I avoid that, right? Let me ask you a couple more on this subject matter. So as a 1031, I want to be clear, because everybody, is going to ask these questions. I'm in a panic. I've sold. I'm in that 45-day window. I'm calling you up. You're not going to direct me to a property or an asset. You're not going to say, go talk to Eckard about minerals. You're going to say, these are the things that qualify. You can't, as a referral, send people directly and say, oh, I got a building back here I can say that it qualify, because it violates your QI responsibilities and independence, right? So I want to make sure the audience understands you've got to be forward planning when you're going to sell, the expectation of profit, get with your CPA, contact a 1031 professional like yourself, but you better be working twice as hard, if not 3 times as hard, about where you're going with the money, or you should just stay put, right? I mean, or would you disagree with that?
What's the old saying about fail to plan?
Yeah, right.
So, you fail to plan to fail. So, my position on any transaction, I sort of touched earlier, when do I want people to think about a 1031? I really want to have them think about when they buy the asset, because I know that people aren't going to own these things forever, but that doesn't get done, right? So my advice to anybody that's contemplating a sale, first thing you're going to do is talk to your tax people. And if you don't have tax people, get good tax people, but you want to understand what your tax liability is going to be, because that arms you with the knowledge to decide what makes sense or doesn't make sense going forward. And tax deferral is no good if the replacement goes away, right? So you got to look at it. And back to your point, if you're paying a premium of 15, 20, 25, 30% on things. I spoke in Vegas just before Thanksgiving for an investment company, and they were people from all over the country, and I just flew in, flew out to speak, but they were talking about the premiums and paying, everybody's paying 25% too much for a piece of property right now, and I was taught, one of my biggest pet peeves is why is what you sell, or why is real estate considered an alternative investment in the investment world, when hard assets are the oldest assets known to mankind, and yet those things are alternative investments. And let's say a synthetic derivative, which got us into the problem last time, is a legitimate real investment. I mean, it just drives me crazy. So what good is tax deferral if you're buying something that goes away? But making sure it's hard asset and it's taken care of. But you want to think about it, talk to those tax people, understand what your liability is going to be, and rationalize what you're doing. Take the time to figure it out. But even in today's world, I get calls, as I said at the top, a day after somebody's closed the deal. Well, talk to your people. Number one, get a great team of professionals on board, and use those professionals. The only dumb question is the one you don't ask.
Well, I can tell everybody looking at this presentation, I've been in the investment world, owned my own brokerage firm for 20 something years. And the one advice I did not listen to when I was very, very young, do not skimp on professional advice from accountants and lawyers. And even when you hire those accountants and lawyers, you should be asking them constant questions. Don't just walk in and go, okay, thank you very much for the answer. Because my response is, because I'm kind of combative anyway, my response is, they'll say, well, you can't do this. I go, why not? Well, you just can't. Well, show it to me. And they're like, what do you mean? Show me the tax law. Show me give me the code. I've been told my whole life, you can't do this, you can't do that. And I go, really, who said so? Yeah. I mean, when I got a coloring book when I was 5, not only did I not draw on the lines, I got blank paper. I didn't even want lines of mine. I just said, you have gone to school, you learned what you learned, your background of data is subject to your input of data. And like you said on the 1031, you can get 15 different responses. Well, which one of you 15 were out partying the night before you took your exam? I don't know. So I think the thing I would like everybody here to understand is, look, whether you're getting advice, medical advice, accounting advice, legal advice, I don't care what the advice is, it's only as good or reliable as the source you're getting it from. Now, what I've really enjoyed about the relationship David and I are creating and have started working on over these presentations, coming down to our conference is, look, I need somebody who actually buys real estate with their own money. I need people who invest in alternative assets with their own money. I need people who talk all day long to hundreds, if not thousands of investors throughout the year who are seeing all these transactions. If I'm talking to somebody who is one-man show, three-man show, they've been around 4 or 5 years, their scope of input data is only 3 years old. They haven't even seen what can happen. In 2008, to me, it was like a light switch. In 180 days, boom, lights went off. There goes the stock market. There goes real estate. There goes bonds, financials. Draw down your line of credit because the banks are seizing assets. It was like somebody blew up a grenade in your financial world. And everybody today is telling me, oh, it's not going to happen. So here's what I would leave you with. We got about 5 minutes left. I want to leave you with the 3 things. One, if you are thinking about selling assets that fall under the 1031 tax exchange, reach out to David Moore, reach out to Equity Advantage. If you have 401k, IRA, they also have their company that does that. And here's the thing. It's amazing to me how many sophisticated investors will wait to the last second or simply not even inquire about all the ways you can use your money. The number one loss in your portfolio is paying taxes. There is a zero return. So within all the legal limits, all the rules, all the guidelines, all the advantages that are there, you've got to take the time to figure out the best way to keep your own money, because you will invest it and make a better return than the federal government or the state governments. So David, let me wrap it up with this. What are your general thoughts, just as more economy question, because I don't want to lose time on this, but what's your thoughts on inflation right now and how that may or may not affect real estate values? I want to hear your opinion.
Well, look at what it's done in the last year. I mean, it's the problem I see primarily is if we look at, what was proposed last year, our volume of business last year was just nuts. And it was all in anticipation of increased capital gains or elimination or restriction at 1031, right?
Panic reaction.
Yes, and the reaction. Anytime that I see Wall Street stumbling, like in the last, well, definitely the last few weeks, but the last few months, the IRA 401k business starts spooling up. Okay, so we do on that side of the business, we do self-directed IRAs, checkbook IRAs, we do solo 401k plans, we do rollover business startups. So anytime we got recessionary things coming on, people get anxious with Wall Street. And some companies' 401k plans won't even let the people go to cash. So I've had people quit their jobs to get access to the money. So it's really important that you use, to your point, Troy, 1, have a great team of professional tax and legal people, but 2, use them and understand what's out there. The problem I see is if we look at section 121, the universal exclusion, and I think that 250 or 500 exclusion that it contained, that's, I think, what the government was probably looking at when they were talking about capping 1031 deferral at $500,000 a year. Well, inflation, back to the inflation comment, 250 or 500 in 1997 should be equate to what today? Maybe it should be $1 million, $1.5 million on stuff. People are now in a situation that inflation's there. They're realizing gains. They think, well, gee, this is great. My property went from X to Y in this period of time. Well, did it really? And now you're paying taxes on gains that are not real. It's all inflation driven. Yeah. And I see that, more and more every day. People are bragging. I mean, I see brokers brag. Yeah, I got 25% over what I listed for this property, or 30 or 40. Well, you listed the price, right? I mean, that's the reality.
You're a bad broker.
It shows how far off you were.
Yeah, I love when they do that, because it's like, you're completely wrong. It means you're incompetent, but thanks for telling me.
Yeah, exactly. I mean, I just don't get it. So I think, back to throwing good money after bad, I think there's lots of times I take pride. This is going to sound really funny, but I really take pride on transactions where I tell people not to do them. Because if I just look at it and say, look, what good is tax deferral if you're throwing things into things you're paying way too much for? Yeah, you're deferring tax at 20%, but you're paying 25% more than you should for the asset, right? So this inflation problems is definitely here, and it's going to be with us. And if you look at the cost of the finance and what's going to be going forward with, I see nothing but problems. Now, I was taught never to bank on appreciation. And that's one of the things, whether it's, some annuity type of stock, or you talk about, the payments during the time of hold. I was taught never to bank on appreciation. That'll come with hard assets. It's going to come, whether it's inflationary driven or market driven for whatever other reasons there. But I was taught, look at what the things are going to do. And now you answer 3 questions. What am I going to make? How am I going to make the money? When am I going to make it? If I can't answer the questions, don't buy it. Now we've got inflation that's driving those numbers off, and it's changing people's, return on investment. So
what I got is, don't pay, even if it's half price, don't buy a 3-legged horse. Okay. I got
correct.
A good deal is only a good deal if the asset's a good deal.
Yes.
See, in my business, you get big tax write-offs for drilling wells. And I tell everybody, it's a tax deferment. It's not a tax write-off. If it's a tax write-off, I'm guaranteeing a dry hole. It's a tax deferment because I should hit you a good well that makes your money back. You're just deferring the taxes. And then I think the question I would get is that, do you see activity this year in 1031 exchanges more or less? We got 3 minutes left, more or less than what it was last year. What do you think the market's going to be like this year for 1031?
My fiscal year is 1031, pretty ironic. But in the last 2 months, we're like 25% ahead of last year, and last year was the best year we'd ever had. So
it's rocking. They're running.
Yeah, it is. And I don't, everybody I'm talking to, I was talking to a buddy that's actually in Las Vegas at a big conference right now, commercial brokerage exchange group that's there. And he said basically the attitude, even the, big guys, we're looking at DSTs, if we're looking at Cantor Fitzgerald or Inland, they're all estimating, hey, we got 2 or 3 years here. So I don't know how it goes that far. But that's sort of the idea there. I'm not a guy that's real comfortable with that. Like we discussed earlier, you and I have been knocked down a little bit. And that 07, 08 thing, I said if I lose half my business, I would have been fine. Well, I lost 90% of the business. It just like you said, a switch was just turned and it just stopped. And I'll say, the reason for that in my space was, the banks go away, you can't transact a deal, right? So
here's my opinion, and then we'll wrap up. My opinion is, anytime somebody's presenting that 2 or 3 year run, my question is, let's just say today you knew 100% it was not a 2 or 3 year run, but we're at the end of the rope. You wouldn't say that because then you don't have a job and you can't make fees. So you're going to tell us whatever we need to hear, because you got to do those next 5 transactions, or you're going to get fired. You don't have a job, you don't earn the commission. So what scares me is, I've never had a financial planner ever tell me, Troy, the market is overpriced. You should go to all cash. They don't make fees on cash. I never had a real estate agent when I'm trying to buy a piece of property go, you shouldn't buy this because I don't need the commission because I'm wealthy, independent. So I can tell you like it is. So today, investors must think for themselves. They must be incredibly smart. They must be very strict and disciplined about getting data and using your gut instinct, because a lot of these wrinkles and scars are from being bounced around over 2 or 3 bad cycles. And you can ring the bell all day long. If nobody answers the bell, well, the house catches on fire and it burns to ground. Hey, listen, everyone, I really appreciate you coming today. This is David Moore. He's the CEO, and he's the guy that heads up a fantastic firm that does 1031 expertise and handles transactions with Equity Advantage. He will be with us in Amelia Island down in Florida at the end of April for our partners conference. He and I will see who can talk faster and who can talk in one breath. I think I can hold my breath for 7 minutes, but I'm going to see if David can do the same thing. But on behalf of David and all of us, hey, David, thank you for your time, my friend. I'll see you soon. And for everybody else, any follow-up questions, send them to us. David has a presentation. I have one. We'll send those out to whoever sends an inquiry. You can do that at my address, Eckard at Eckard Enterprises. And you can contact David. We'll have his information out as well. Look, if you're going to do a 1031, if you got retirement money, go see Dave and his team. They do a fantastic job, and I couldn't recommend somebody with a higher level of expertise than what I've done right here today. Thank you, everyone.
Thank you, Troy. It's been fun as always, and look forward to seeing you, Amelia.
Yeah, happy hog hunt. We'll see you, brother. Thank you.
Yeah, take care. Bye-bye.